Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And I'm excited you have joined me live today to discuss the risk and rewards of how to safely arbitrage lines of credit in order to get higher returns when you invest. Now, if we haven't met before, again, my name is Whitney Elkins-Hutten, but really, I want you to know you're in the right place. If you've tried, let's see if I can get my presentation moving here. There we go. All right, there we go. So you're in the right place if you want to turn your active and income and savings into passive income and wealth, or maybe you want to scale your passive investing. Maybe you've tried to do it before and realized you just really couldn't get comfortable with the investment, or you actually invested in a deal before and realized, oops, I made a mistake, or you're just here ready to level up your knowledge. If that is you, you're in the right place. Now, again, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at passiveinvesting.com. But I didn't, go to school in order to be in my position here at a private equity firm. I actually started off probably much like you, just working my regular 9 to 5 job, wondering how I could get ahead in life. And back in 2002, I bought a property with a significant other. Month later, the relationship fell apart, but that really got me in the real estate game. Since 2002, since that first live and flip and house hack, I've been able to scale over 800 million in real estate holdings, including 6,500 residential units, various cash flowing businesses, as well as other commercial assets. And I've done my fair share of fix and flips as well. But I share all that knowledge with you here as my role at passiveinvesting.com, but also in my book, Money for Tomorrow, How to Build and Protect Generational Wealth. Now, you can get that here at biggerpockets.com. You can also get it at amazon.com. But really, what I most importantly share in all the information, all the webinars that I do here, everything that I have in my book is really to help you achieve one result in life. And it isn't always about financial freedom. I feel like financial freedom is something to strive for, but the money is a tool. What is the money trying to do for us? Well, we're trying, when we are financially free, financially independent, we're trying to get choice and control on how we spend our time. And that is what I've been able to do with active real estate, with passive real estate, with cash flowing businesses, is get 100% control and choice on how I spend my time. And I love spending my time here with you to help you figure out how to do the same thing. And we can help you do that here at passiveinvesting.com, whether it's through our debt holdings, such as our PIC Real Estate Debt Fund 1. Our Rehab Wallet lending arm actually deploys the capital in that debt fund. We have over 380 million lent through that lending arm, or whether it's through our equity assets. We have several different avenues on how we can help produce income for our investors. Now, if you haven't done so already, make sure that you join our passive investing club. There you get priority access to our deals. You can jump on a one-on-one call with me to understand how we can help you meet your investing goals. Then, of course, you get additional education like these podcasts and boot camps. Now, for those of you who are listening on your favorite podcast player of choice, you can actually, if you can't see the QR code, you can visit passiveinvestingwithwhitney.com to get access to those open deals and get that one-on-one call with me. Now, today we're going to talk about arbitrage. So we're going to go over some numbers, but nothing that I go over today is financial advice, legal advice, tax advice. So make sure you take whatever you learn today. And matter of fact, in any podcast or any blog that you read, you take it back to your investing team to make sure that that investment decision is right for you. Okay, so we're going to talk about how to safely arbitrage. Now, we have new investors on the show that are listening to the show. We have, more seasoned investors that completely understand what I'm talking about when I say arbitrage. But let's get everybody caught up. And really, we have to start with the word leverage. Okay, so what is leverage? Well, Leverage is borrowing capital to invest in a deal, say like buying a piece of real estate, buying a primary house, your single family rental, multifamily building, a self-storage building. And you're borrowing capital, say like from a bank or a private lender, and you're doing that in order to get a higher return on your investment than the cost of the borrowing. That's what leverage is. So essentially you're getting a loan. Now, leverage is best suited for, real estate investments, real estate syndication, cash flowing businesses like express car washes. Now, there is a third thing noted here. If you're watching everything on YouTube, I say note funds and debt funds. Okay, yes, you can use leverage for note funds and debt funds. And we talk a lot about that here on the Masterclass. And that is probably my least favorite use of leverage because it introduced a lot of risk there. But anyways, yes, you can do that. But my favorite place to use leverage is whenever you've got an asset that's going to not only create cash flow, it's going to appreciate, it's going to throw off tax benefits for you. Okay, it's going to give you multiple ways of making money. Okay, and that's where real estate, buy and hold, real estate syndications, and cash flowing businesses come into play. And so that's simply getting a loan from a bank, a primary loan, maybe even a second loan. Now, why should you as a passive investor care about leverage? Well, leverage can help amplify your returns, but you also have to make sure that it's being, properly used, because just like leverage can amplify your returns, help you make multiple investments, buy multiple properties without tying up all your capital. Okay, you still need to make sure that you have enough liquidity for emergencies and other investments, and you need to make sure that you're diversified. Okay, now leverage can help you diversify faster. Okay, then say you're going out and buy a single family property. So say you have $100,000 to invest. You can either go buy one single family property and be invested in one deal, it's all cash, or you could take that $100,000 and buy 4 single family properties in multiple markets. Okay, same thing with syndications. You could take, say, $500,000 and you could put that all down on one syndicated property, or you could take that apart, and do 100,000 in each. Okay, each one of those investments is probably using leverage, some sort of loan. Now, how does leverage tie in with arbitrage? Okay, well, arbitrage is actually a strategic use of leverage. Okay, so arbitrage is the practice of taking advantage of a difference in returns in 2 separate deals, okay, and capitalizing on the difference that's created, essentially you making profit. So you could invest in a multi-family deal that is going to say, give you a return of 15% in, IRR. And you go borrow, say, from a line of credit, maybe it's a whole life insurance. We'll go through the various lines of credits here in a minute, but you're borrowing at 5.5%. Okay, so essentially you can create a delta there, and out of thin air and put in your pocket. Okay, this is what banks do. So they essentially get a deposit. Okay, like I get my paycheck, I put it in the bank. The bank says, okay, I owe you this money, but I'm going to take your money and I'm going to go make money with that money over here. Okay, and I'm going to keep the delta. So I'm going to charge this person over here 9%, and then I'm going to give you, say, 2% on your savings. So they get to keep an arbitrage of 7%. Okay, we're doing the same type of practice, leveraging 2 different deals going at the same time in order to keep the profit or the difference between the 2. Now, the purpose of this webinar isn't necessarily to convince you that arbitraging is a good idea. I want you to understand the risk and the rewards of arbitrage and those questions that you should have in the back of your mind to see if it's a right strategy for you to employ, put to use in your portfolio. Okay, so this is by no means me trying to convince you that arbitrage is a great idea and it's for everybody. It is absolutely not. We have to take into consideration, is this a strategy that works for us? And one of those things that we have to make sure that works for us is the type of credit lines that we have access to, because that will impact if arbitrage is something that we could actually utilize and if it's smart. So there's really 4 different buckets. So as a passive investor, if you were looking to borrow capital somewhere to invest in a passive real estate deal or an equity deal or a debt fund deal, okay? So maybe you're going to get a 15% return over here from the deal, and you're going to borrow at a lower percentage, say 5%, okay? You can create money essentially out of thin air, all right? But we got to know what those lines of credits are over here and how they kind of work, how they play. Well, the first bucket is what we call securities-backed lines of credit. This leverages your investment portfolio without requiring any asset sales, okay? So this is like a very high level strategy. Maybe you have, 5 million or 10 million in, investment portfolio. You go to the bank and say, hey, can I get a line of credit? And I'm going to pledge my investment portfolio as collateral in order to get that line of credit, all right? Another way you can do it is you could pledge your business. Okay, you could get a business line of credit. Maybe you're a small business owner. You have a plumbing company, HVAC company, tech company, whatever. You could go to the bank and say, hey, I'm going to pledge my business to get some money for you so I can go invest it over here and make the arbitrage return. Now, you just need to make sure, those are questions we're going to get into later is, what are the repayment terms? What's the repayment timeline? What interest rate are you paying? And also understanding what kind of capital or collateral did you put up in order to secure those lines of credit. Okay, now 2 of my favorite ways, if I'm going to say favorite, like if I were to do this, is to take advantage of my home equity and line of credit, because this gives me flexibility. Okay, so I could take, maybe you have a primary residence and, over the past, you've held it for 5 to 6 years, you've got a nice cushion of equity in that property. You can go to the bank and say, hey, can I get a home equity and line of credit? And with that line of credit, it is, kind of like a little checkbook in a way. And so you could, take money out to go invest. You can also pay it down, with the income that's coming in from the investment. All right. But you still have the asset there that you could sell and make everything whole. That's the same thing that you could do with the security-backed line of credit and the business credit, but then you're getting rid of your livelihood. Here, we don't necessarily want to get rid of the roof over our head, but we probably could, that's easier to replace than building a business from the ground up again or rescaling our investment portfolio. Now, my favorite way, if I were to arbitrage, is going to be using a whole life insurance policy loan. So I could actually access the cash value of my whole life policy at a low fixed interest rate while keeping the cash value of the policy intact. Okay. So this allows me, so essentially I have a whole life policy at, one of the big 5, whole life carriers. Now I might have, a few $100,000 built up in my cash value, but I go to the carrier and I say, hey, I want to pledge my whole life insurance policy cash value in order to get a loan. All right. So I haven't liquidated any assets. And essentially that whole life carrier takes a look at what is the value of my cash value in my whole life insurance policy. And they say, okay, great. Like you have that there. And if you die, the policy will pay off the loan and then any of the balance will go to your heirs. All right. So it's kind of a safer way to get a loan for these type of things. But that is another way. So there's 4 different buckets there of lines of credit. Now, which one's right for you? If you were going to do this, if you were going to leverage, well, just remember, we touched on those 4 different buckets. Not all of them are created equal. Okay, so you want to make sure you match the one for your right financial situation and investment goals. So take a look at what best suits your needs. Understand what the interest rates that are being charged. When do those interest rates fluctuate? Because almost in a line of credit, interest rates are not fixed for a time period. They generally will fluctuate, based on, say, prime, interest rate, or, maybe SOFR, some other type of metric. Okay, they have different timelines and repayment terms. They also have different risk of pledging collateral. Okay. And one, you're pledging your investment portfolio, and another, you're pledging your business, and another, you're pledging the roof over your head. And then in a fourth opportunity, the whole life insurance policy loan, you're actually pledging the cash value in your life insurance policy. Okay. So make sure you understand all of that before you execute this type of strategy. All right. Now, what do the numbers look like? How do we create money out of thin air with this type of strategy? Well, we need to understand we can take advantage of simple interest, we can take advantage of compounded interest, and then we can take advantage of equity growth. So I'm going to show you 3 different ways you could utilize a line of credit to arbitrage your way into a deal. Now, the first 2 are going to be, we're going to be looking at examples of somebody taking advantage of a home equity line of credit, investing into a real estate debt fund. Okay, so there's no leverage. Okay, we're going to assume no leverage on the real estate debt fund. Okay, this is one of my favorite surefire ways. I shouldn't say surefire. We never should say that. It's one of my favorite ways with minimal risk to arbitrage. So you could go to your line of credit, whichever line of credit, borrow, say $100,000, and maybe the interest rate on that line of credit is 5%. So in year 1, the cost of that line of credit is going to be $5,000. Now you're going to take that $100,000 and you're going to arbitrage. You're going to invest it at a higher interest rate. So we're going to invest it at, say, 8% in this example, and we're going to get $8,000 per year in cash flow. Now, the line of credit, or excuse me, the cash flow from the investment is paying off the line of credit. So we get to pocket the delta between $8,000 of income coming in and $5,000 of expenses going out. So we get $3,000 a year. Okay. Now somebody might be going, that's not that much money, but that kind of found money. Again, you created it out of thin air. You were the broker between the 2 deals, and you get to keep the profit. Now so remember, the proceeds from the debt fund are paying the expenses of the line of credit and creating that $3,000 of additional income. That's just simple math. Okay, we're taking advantage of simple interest. Now, what if we found a way to invest it instead of just getting simple interest on, say, like a monthly return that's being paid for us? Instead, we could go into a debt fund that offered compounding. And so same person takes their HELOC and they put it into the debt fund, but allow it to compound. And they intend to hold it for 10 years. All right. So again, they're borrowing $100,000 at 5%. Okay. $5,000 a year of holding costs for that particular deal. Over 10 years, they're pay out $50,000 in interest. Okay. Now they don't have any cash flow coming in on a monthly basis, right? Remember, they're in it for the long game. They're trying to get compounding interest, not simple interest. So they've got to find a way to figure out pay that $5,000 from other investment income or other cash flow that's coming in. But here's the magic. That $100,000 they took from their HELOC, they invested it into a debt fund at 8%, but now instead of getting paid simple interest, they're going to wait for it to compound for 8 years and get paid compounding interest. Okay, now at the end of 10 years, that $100,000 is turned into $215,892 and change. Now, back out the $100,000 that you have to pay off the loan, back out the $50,000 that you've paid for the hold cost on that loan, you're left with $65,892. Okay, or you've essentially more than doubled your return annually. Okay, instead of making $3,000 a year, on that same money you've made $6,500. That's the magic of compounding. Now, if you're watching this video, you've got your borrowing costs will most likely fluctuate on that line of credit. So I would like to say you would be paying 5% a year, but we need to think about that. It's maybe one year it's going to be 4.5%. Another year it's going to be 6%, right? So we're kind of playing with average numbers here, but in almost every situation, you end up ahead. Now, how does this look in an equity deal? I'm going to paint a very general 30,000-foot view picture for you. You could take the same high income earner, maybe they take a loan against their whole life insurance policy line. Why do I like that? Well, because what if the deal goes past 10 years? Okay, they're not beholden to pay back their loan in 10 years like they would be on their home equity line of credit. Okay, remember, we got to match the line of credit with the deal strategy, just like you have to match the leverage on any multifamily deal, self-storage deal, express car wash deal with the business plan of the deal. Same thing here. If you're going to arbitrage, you have to match the type of line of credit you're going to use with the timeline of the deal. Okay, now this is in theory a 5-year hold. Okay, but what if it went 10 years? Okay, you don't want to put yourself in a pickle where you have to figure out a way to pay off the HELOC. Okay, let's use a different line of credit here. But same numbers, we've got a borrower, $500,000. The cost of the loan is 5%. We already know that this is going to cost them $5,000 a year, and they're going to hold it for 5 years. The deal is 5 years. So their total expense cost for the loan that on that line of credit is $25,000. Now they took that $100,000 and they invested it into the deal. Okay, this express car wash deal. But maybe year one, that express car wash only threw off 5% cash flow. Okay, so they're just breaking even here. All right. But over time, the cash flow is going to grow. All right. But that isn't the play. That's not the play this investor's making. The play this investor's making is on the equity. Okay. And so that at the end of the 5-year hold with a 2x equity multiple, okay, let's assume that $100,000, they double it in 5 years. They take the $200,000, they back out their holding costs, which were $25,000. They back out their initial investment, $100,000. They made $75,000 across 5 years. So essentially $15,000 a year. Now, all along the way, they've been getting paid annual tax benefits, okay, which helps them create velocity in their portfolio, shelter income. And they've been playing the long game in order to get that equity multiple. Now, I make this sound all easy, that nothing ever goes wrong, and that's simply not the case, because you need to make sure, again, that your borrowing costs, again, are going to most likely fluctuate during that 5-year period. Okay, so my rule of thumb is if you're going to deploy or try to arbitrage into an equity deal, I'm looking for the year one cash flow to at least cover 50% of my borrowing cost, so I don't go upside down really hard, really fast. All right. Now, again, this is not necessarily a strategy that is like, that nothing ever happens to, right? Arbitrage, just like using loans on a deal, can work for us or work against us. So we need to understand the risk of arbitrage. What are the major risks here? First major risk, we already saw it. It could be, cash flow compression. Maybe the returns are low in the first few years of the deal, and you got to figure out a way to cover that. Or maybe you hit a market where the returns start dropping on the deal for whatever reason, and you got to cover that. Second big risk is over leveraging, okay? Meaning that your debt exceeds the manageable limits in your portfolio. We'll talk more about that in the next slide. And then we've got our big players like capital calls and then loss of principal. So let's take the first two here. Cash flow compression, okay? Arbitraging is a delicate game, okay? It can leave very little room for market fluctuations, especially on equity deals if you're arbitraging on equity deals. Now, if you're arbitraging on a debt deal, okay, with good liquidity options within that debt deal, you can get out of the debt deal. It's a little bit safer, right? The market starts moving on you. You can, make some moves really quickly. But if you're locked in on the equity deal, you're in for the ride, okay? Also, the cost of the capital could exceed the return on your deal, okay? We don't want that happening. That comes with great underwriting, all right? Then we have to look at you personally as an investor, okay? Before you think if arbitrage is something that you want to do, are you already over levered in your portfolio? Yeah, I've seen so many investors that want to lever to the hilt on their portfolio and they have zero cash reserves. They're in all equity deals and they have no debt deals. in their portfolio to stabilize, the volatility ride. Okay, take a look at your leverage position before you execute a strategy like this. Okay, and then it's not a matter of if you'll ever have a capital call in a deal, it's a matter of when. Okay, now capital calls, if you're buy and hold single family investor, you have an HVAC, a roof that needs to go on. Those are capital calls. Okay, so capital calls don't have to happen because of interest rate issues or lending issues. They can happen because you have a loss on the property of some sort. Okay, so you need to make sure before you start arbitraging that you have maintained liquidity and reserves to cover. In my book, my rule is that I maintain 12 to 18 months of loan payments if I'm going to use arbitrage. I've got 12 to 18 months of loan payments set aside. That way I can hopefully navigate through that market and get to the other side. Okay. Again, remember, arbitrage, just like leverage on on the actual asset in the deal, can magnify rewards, but it can also magnify risk if not used properly. Now, we do have some of our rare risk. Okay. And it's not, I don't want to downplay these, but they happen less often. Okay. Which is you have fraudulent operators, people that just go poof in the middle of the night with all the money. Okay, if you are levered or arbitraged into a deal like that, the chances of you getting money back is kind of slim to none. Okay, so take care. Our operator, we want to be with somebody that we know, love, and trust. We've already talked about capital calls. They do happen. They happen less often. And I should say they happen more often in recessive markets than they do at other times. And then we've just got our general market downturns. Okay, but rare risk can happen. So you need to prepare and try to navigate that risk as quickly and smoothly as possible. All right, so in wrapping up today, how do we protect ourselves when we're going to use this arbitrage strategy? Question number one in my book is, does the deal that you're looking to arbitrage in actually match your goals, risk, and timeline? Would you invest in this deal even if you were not going to take out a line of credit in order to invest? If the answer is no, you don't arbitrage. Okay, if the only way to make the return something that you would actually put in your portfolio, that deal would be something you'd put in your portfolio through arbitrage, don't do it. It's too risky. Okay, there's not enough skin in the game for that. Number two, are you investing with an experienced operator that you know, like, and trust? Okay, the operator is going to help navigate that deal. If it hits rough waters, we want the experts in our corner. If the asset itself is levered, which most multifamily, most businesses these days are, they have some layer of loan on the property. Is that original loan risk mitigated? The reason why we want to ask that question is we want to minimize one of the biggest players in capital calls, right? Do you have the reserves set aside to cover all of your personal emergencies, all of your business emergencies, and 12 to 18 months to pay back that loan should you get zero cash flow from your deal? If you can't say yes, don't move on. Don't use arbitrage. All right. Now, if you said yes to questions 1 through 4 and you're still super excited to use arbitrage in a deal, cool. We have a couple more checkpoints here. The first one is make sure you look at your portfolio. Are you already over levered in your portfolio? If you are, stop. Okay. All right. Number 6, can you match the right line of credit with the deal that you're going to arbitrage? All right. If you have to do a mismatch between the line of credit with the type of line of credit that would best match an arbitrage strategy for that deal, I would pause. Okay, so if all you have is a secured back, line of credit on your investment portfolio to go into an arbitrage deal that's going to be, say, 3 years, 5 years on an equity deal, that might be a bit of a mismatch there, because if something went wrong and your timeline doubled, you might be on the hook to pay back the bank, whether you make cash flow or a return or not. Okay, and then number 7, just take a deep breath. All right. When you arbitrage a deal, yes, you can make a higher return. We all love higher returns. You saw those three examples where we looked at simple interest, compounded interest, and taking advantage of arbitrage into an equity deal. Don't get starry-eyed on the return if you're not willing to take the risk. All right, guys, this is my call to you. Make sure to join our passive investing club. Again, there you get access to our open deals, a one-on-one call there with me to discuss your investing goals, access to our free educational masterclasses and other resources. You can scan the QR code on the screen or visit passiveinvestingwithwhitney.com. And if you're here live, don't go anywhere. We're about to start the Ask Me Anything part of our show. All right, guys, that was a lot. I should have made that a boot camp. By the time we got all the way through that, I'm like, wait a second, this is a lot. We should have made that a boot camp. But yeah, so if you guys have questions, jump on over to the questions box or the Q&A box and let's get them answered. What did you like? Okay, what did you wish I would cover? Was this useful? You guys are pretty quiet today. Was this useful? Let's see. What experience have you seen using crypto Bitcoin loans as arbitrage? I have not. I have not, but let's talk about that. Because I've seen people I don't personally have experience with it, but I think it's called staking, where you take your Bitcoin and you stake it out. And you know what happens when Bitcoin goes from, I don't even know where it is right now. I think it's like pretty high. I think like $60,000 down to 30. Okay, but you as the borrower are on the hook to pay, you know, as if it were at 60, not as if it's at 30. Okay, so again, that's kind of like reverse of the situation that we're talking about right now. But yeah, it is an issue. You need to think about that. I'm looking, if I'm going to use arbitrage, I'm looking to go into a deal that has stabilized returns or something I am extremely familiar with, that I'm like real estate, like buying a multifamily building. If I do it right, I have a history and a background in this. If I do it right, generally the value of that property I can affect and it's going to go up to the right. Am I going to have blips? Absolutely. I will have blips every few years. I'm going to have a tenant turnover. I'm going to have something break on the property that I have to replace. I'm going to hit a down market. But in general, the asset value will go up because I can increase the net operating income. Okay, that's a little bit safer because I get to pull most of the levers that create the value. I do have to depend a little bit on that market, right? The cap rate. Okay, but very little. I can affect a lot of the value. Here's my kind of, if you're trying to figure out what should I arbitrage into, Google what will banks lend on. If banks will not lend on Bitcoin and crypto. If they're not willing to lend on it, why would I go get a line of credit to like try to do that? Like I'm taking, there is you have to understand what the risks are there. You have to be prepared to lose it all. Okay. But if you want to do this, if you're like my normal kind of like really like pretty conservative investor that wants to be pretty hands off, I would stick to the things that don't get starry-eyed by returns, promised returns. Stick to the things that are pretty much like in the wheelhouse a little bit. And like I said, my thing is like I always look to see what banks are lending on, okay, and play that game. How do taxes affect returns? Of course they do. So, you know, in the debt fund, we don't have any tax advantages. So you're going to be paying that person, that investor, hypothetical investor would be paying taxes on either the simple interest income of $3,000 a year or on the compounded interest. But here's the thing. If I have other assets in my portfolio that would allow me to offset that income in some form or fashion, okay, I can shelter it. Okay, so this gives me a unique opportunity. And this is how I use arbitrage in my portfolio. I sit down with my accountant for one, and then I like kind of map out like what losses I have coming into my portfolio, and then how much capital I can deploy. And right now, I'm going debt and debt-like investments are what the market's giving us right now. I'm taking full advantage of that. Okay, so I'm trying to lock in, as much tax-free cash flow to stabilize my portfolio. But yeah, how does it affect your returns? All I can say is it does. You can sit down there with the accountant. I'm also, my second comment to that is do not let the tax tail wag the dog. All right, remember, you're creating free money here out of thin air. Okay, you borrowed from this person over here to lend into this deal over here to invest in this deal, and then all of a sudden you got paid $3,000. Awesome. Okay, instead of that, that was a net profit to you. Okay, if you have to pay a little bit of tax on that, you still made free money, right? So arbitrage isn't necessarily, I tend to look at the use of arbitrage as, free ATM money. Like this is something that I wouldn't have gotten otherwise if I didn't play the shell game between the two. But yes, taxes do play into it. You could go fully optimized. That actually keeps a lot of people from doing this. Do any of our deals take 1031 exchange funds? There are ways to 1031 exchange into equity deals like multifamily and self-storage. And we will do that. We don't, but again, you still have to play by all the 1031 rules and timelines. And so we don't have anything in the hopper right now to offer, but yes, for our multifamily deals, typically we'll work with investors that have a million of equity to place in a multifamily deal or $500,000 into a self-storage deal. Now, the natural next question I get is, can I 1031 exchange into an express car wash? The answer right now is no, because you'd be taking 1031 exchange money from a real estate deal going into an operating business, and we don't have a way to deal with that right now. We're working on it. But if you want to know more, you can want to have a conversation about 1031 exchanges, reach out to me at whitney@passiveinvesting.com. What other questions do you guys have? Somebody said, great overview of leverage options. Yeah. Well, remember, there's leverage. So I tried to really make this draw the lines, paint the box. So the leverage is the loan on the actual deal asset itself. The arbitrage is the game that you play as an investor to go borrow from somebody over here from a line of credit to go invest over here. Okay. Again, it is not for everybody. It is not for every deal. Okay. We want to make sure we are doing it safely. Okay. And that your eyes wide open. Don't get starry-eyed by the returns. If you cannot go through those 7 questions that I put on the last page and have a resounding, heck yeah, this is amazing to every single one of those questions, then arbitrage is not for you. Okay. That's cool. Now we know where the line is. Okay. And like I said, like sometimes I'm really cool with arbitrage, and the other parts of the market, I'm like, heck no, I'm going to sit on that cash. I'm going to, be able to weather any storm that comes my way. How stable were the returns on the debt fund over the last 2 to 3 years? Debt fund, yeah, very stable. Like we've paid it out like clockwork on a monthly basis. Why is that? Is because on our PIC real estate debt fund, it is invested in fixed and flip first position loans that are fixed and flip loans. So they're cycling out every 6 to 9 months. And that borrower is not price sensitive at all. Okay, they're used to borrowing at 12, 13, 14% and paying 2% in fees. Okay, and points and fees to close the loan. So if the market goes up, we have been able to keep our interest rates. Could we have raised them higher? Yeah, we could have, but we didn't because we wanted to build our borrower base. We took it as an opportunity to scale our business. As interest rates go down, which they haven't really gone down a whole lot in the grand scheme of things, and we don't anticipate them going down much further now. Remember that fix and flip loan, when the prime mortgage rate was 2%, almost darn near free money, that fix and flip borrower, they had no access to that deal. Okay. They had to get hard money lending, which was 12 to 14%. Okay. So, they're pretty price insensitive. And so, yes, our returns are going to be pretty stable in that type of portfolio. Could the interest rate move? Absolutely. Nothing in life is guaranteed, but death and taxes, right? Right now. And so, but yeah, like we're playing in a field, the debt fund, has the assets that are in the underlying part of the debt fund, are pretty secure. Again, less price sensitive than other parts of the market. All right, I'll hang out here for another minute. Guys, thank you so much for taking your time, not only to spend it here with me, but as I always say, invest in yourself, because this is a complex topic to try to master. And I think a lot of people will, see a reel on Instagram or on Facebook and go, "Ooh, I want to go do that." And then they don't learn the ins and outs of it. They don't understand the risk and they get burned. I've seen, I'm a part of one deal that unfortunately has like completely unraveled. It's not a real estate deal. It's nothing here. But a lot of people borrowed millions and millions of dollars from the bank and it went poof. So you have to, again, understand the risks that you take in order to do arbitrage. And again, number one, who is the operator? Do you know, like, and trust them? I mean, have they been through the rigor? Have they stuck through thick and thin in this market? Because if they haven't poofed in this market, the chances of them going anywhere in the next 5 years or 10 years or 15 years is pretty darn slim. We call that the Lindy effect. And so that's kind of a rule of thumb in business. So if they've been around, for 5 years or longer, have navigated this market, the odds of them being around for the next 5 years, I mean, goes up immensely. All right, guys, you have a great day. We will see you next week. Take care.